I think it's fair to say that this cycle can be characterized as an institutional cycle. The majority of price action, the reason why we see the all-time highs, the majority of the technological innovations, they're mostly happening on the institutional side and not on the retail side, how it was previously, in the previous cycles. I personally happen to work with a lot of institutions in Binance. I have a chance to talk to them to understand why are they buying crypto, what are they looking for when they're buying crypto, what are some of the blockers on why they cannot buy crypto, and sort of what's the roadmap are looking like for them in the future. And I'd like to share all of this information today with you, and perhaps altogether we can derive some alpha from it and understand how they're positioning their portfolios and how potentially we could position ourselves to make some money along the way as well. My name is Khashim. I'm working as an institutional sales manager at Binance, and yeah, let's get this started. So first, let's talk about the effects that institutions have on crypto. Here you can see this is the Bitcoin price chart. This beautiful red arrow shows the moment when BlackRock launched their spot Bitcoin ETF. It happened in January of 2024. The Bitcoin was at the moment at around $40,000, and ever since then we went to an all-time high at around 125. Right now we're consolidating at around 112, which is approximately 3 times growth over that time period. Ever since of January 2024 up until today, BlackRock spot Bitcoin ETF IBIT have been able to accumulate 750,000 Bitcoins on its balance. They're holding it on behalf of their investors. 750,000 Bitcoins, that is a lot. Altogether, between different ETF issuers, they were able to accumulate approximately 1.2 million Bitcoins on their balance sheets. So there's 21 million Bitcoin in total. Between all of them, they have 1.2 million in 1.5 years. That is approximately what, 5% of the total Bitcoin supply. Now, I want you to run a little thought experiment, right? Try to imagine how many Bitcoins you have on your balance, right? Maybe on your hot wallet, on your ledger, on your exchange. Just try to think like, how much do I have? And then try to look at the people around you and try to think like, all together, if we would combine all of our Bitcoins, how many would we have? Like 1, 3, 5, or maybe 10, right? Maybe we have some whales here and we can accumulate 10 Bitcoin between all of us. Let's continue that thought experiment. Let's try to think what would happen if you take all of your money, right, across all of your altcoins. Maybe you invest in stocks, maybe you own a house, maybe you have some savings. And let's say you take all of your money and you buy Bitcoin with it. And then we take all of the money from all the people in that room and we all buy Bitcoin with it. How many would we have? Maybe 10, maybe 20. Right? Maybe we have some whales here and we can accumulate 30 to 40 Bitcoin just across this room if we can just get it together. Now try to compare it to 1.2 million that the spot ETF issuers have accumulated. The point of that exercise, I was not trying to like degrade all of you or to downgrade how small our balances are, but I was trying to show how big those institutions are and how big of a role they are playing in this cycle. Different slide. So it doesn't end with the ETF issuers. Then there is a Bitcoin treasury companies, formerly known as MicroStrategy, nowadays known as a Strategy, is a company that pioneered and adopted the Bitcoin treasury. The idea behind this is that they are issuing a convertible debt or preferred stocks, and with that money they buy Bitcoin, they put it on their balance sheet, and then they issue more convertible debt and more preferred stock, and they buy more Bitcoin. It's a very, very interesting model that they've accumulated. They started their treasury strategy in August of 2020. And ever since then, they were able to accumulate approximately 650,000 Bitcoin on their balance sheets. 650K. Now, if we add it to the 1.2 million that the spot Bitcoin ETF issuers have, all in all, we're going to get to a number like approximately 1.8 million in 1.5 years. That's what, like, so if we take, let's say, we round it up to 2 million, there's 21 million Bitcoin in total. That's already like short of 10% of total supply, right? 7 to 8% is already in the hands of the institutions. Now look at what happened to the MicroStrategy stock ever since then. They were traded at $14. Look at that, that was a dead stock since 2002. A lot of people in this room maybe were not born in that period yet. Up until 2020, they were traded in that dead range of $14. Then they adopted the treasury strategy, and now they're trading at approximately $350. You know, 3,000% growth, and from the moment of adoption, it's about 20x growth. That's pretty good, even by crypto standards. There's a lot of different Bitcoin treasury companies. It doesn't stop with MicroStrategy, but it also doesn't stop with the Bitcoin treasuries only. There's an altcoin treasuries companies now as well. Bitmine immersion. If there's any people here who follow the traditional stock markets and you watch all the ETFs and maybe you watch CNBC, maybe you know a name of a Tom Lee. This guy is he's sort of a legend on Wall Street. He now leads the Bitmine immersion, which used to be a Bitcoin mining company. They decided to change the vibes a little bit. They restructured to the Ethereum treasury. And the beautiful red arrow there shows the moment when the Bitmine adopted the Ethereum strategy, Ethereum treasury strategy, and that beautiful green candle from approximately $2,000 up until the all-time highs is just the effects of the Bitmine. And we got to 4,900, which is the all-time high. Now I think we're consolidating around 4K. It's across the industry, that's fine. For that period of time, which is approximately 4 months, they were able to accumulate 2.5 million Ethereums on their balance sheet, which is approximately 2% of the total supply, of the total current supply of Ethereum. It's constantly being issued more. I do not have a chart of the Bitmine stock, but since they adopted the treasury strategy in June, they have went 500% up on the stock. So what's the point, right, of me telling all this? The point here is that if you are waiting for the alt season, right? Like, oh, when is the alt season? Is alt season coming? Alt season is already here. It's just not happening in ICO coins. It's not happening in the DeFi coins. It's not happening in the NFTs. It's happening in the crypto stocks. It happens with the MicroStrategy. It happens with Bitmine and with all the others. Let's talk about why this is happening and why are institutions buying crypto. Now, I have to make a disclaimer here that the institutions, so far I've been referencing to them as a single group of people. It's not really, there's different sorts of institutions. There's governments, then there's asset managers, there's hedge funds, there's market makers, or collectively they're known as institutions. But each of them has a little bit different goals, which is why they have different strategies to achieve those goals. This is why they have a little bit different investment strategies as well. So they view crypto through the different lenses. I'm going to try to talk about all of them, but I want us to start with governments first, because I think it's the funniest part, and they're the biggest cohort in general. I happen to onboard many different governments on Binance. They're very discreet, so I will not be able to mention any names, but I had a chance to talk to them and understand why they're trying to buy crypto, why they're diversifying. And the reasons are differing from time to time, but the main two that I was able to identify is they're trying to hedge against the inflation and M2 expansion in the US, and they're geopolitically hedging against different events. If you think about the first point, which is the hedge against the inflation, you can think about it from this perspective. A couple of years ago, there was this nice, cute, maybe not nice, event which was called COVID-19. You may or may not remember that it happened, and which led to majority of the countries leading to a big lockdowns. And majority of the countries implemented a very aggressive fiscal measures to boost the economy while it was under the lockdown. In the human language, what it meant is that the majority of the governments were just basically printing money, and then they were doing what's called like a helicopter money, where they were just like basically giving it away to everyone who is locked down. What happened to the US dollar is the Treasury and the Federal Reserve have expanded their balance sheet of M2 by approximately 30%, which means that they just printed 30% more of dollars than they had existing, which led to the worst inflation in decades, in 2022 and 2023. If you are a non-US country and you have your central bank and you have your diversified portfolio of different currencies, you're probably not very happy with your USD depreciating 10% year over year, which is why you're looking, you're looking to diversify from it. This specifically intensified when we're tying in our second point, which is the current geopolitical situation. Every day there's something crazy going on in the news, which I think most of you have noticed. It specifically intensified after Russia invaded Ukraine in 2022, and they got sanctioned. They got cut off from SWIFT, and 300 billion of Russian assets were frozen in the EU. To this day, these funds were not given back to Russia. I'm not here to talk about the political side of things or the moral side of things, but purely from the monetary and fiscal side. If you are an Eastern country, right? If you're China, if you're India, maybe you're Iran, Saudi Arabia, you're a country in the Middle East. If you're any non-NATO country, then you're looking at this and you're thinking, okay, so if I do something where I misbehave, chances are, and it's not guaranteed, but chances are they will cut me off from the banking system and they will take away all of my funds in the developed markets. Next thing you know, you start looking at your balance sheet and you actually are over-invested in the developed markets. So once again, you need to diversify away from it. Side note, like random thing, who here have been following the price of gold recently? All right, that's a lot of people. So you guys would know what I'm talking about. The price of gold right now is at $3,800, which is the all-time high. Gold is 40% year over year. It's growing 40% year over year, which is, it's pretty good, 40% year over year, even by crypto standards, like, oh, that's pretty good. But keep in mind, gold is the biggest asset in the entire world. It's 10 times bigger than Bitcoin. It has $20 trillion in market cap, and it grew 40% year over year. What type of buying power can drive gold to go 40% year over year? Governments. So for those two specific reasons, they were diversifying their balance sheets from developed markets to gold. They were driving it 40% year over year. And for that exact reason, let's tie it back to the crypto, they're buying now Bitcoin. You're asking, well, they're buying gold. Why are they buying Bitcoin? Bitcoin is a better version of gold. It's more scarce. There's only 21 million of Bitcoin. While you can still keep finding gold underground, it happens every now and then. And you can transact with Bitcoin, which you cannot do with gold. If Russia and China, they have tons and tons of gold, somewhere underground in their vaults, nicely secured, and it's nice and it's pretty good. But you go and try to pay for I don't know, rice or some random raw materials in the international trade, and you need to send 5 tons of gold to China. Good luck. It's never going to happen. Which is why they're diversifying into Bitcoin, because this is something that can be settled in the international trade. So what do they think about different cryptocurrencies? As I mentioned, crypto is not a single asset. It's a lot of different assets and different subclasses of those assets. So let's go through each of them and understand what do institutions think about different of them. We already covered that pretty much. Bitcoin is seen as a digital gold. by both institutions and private institutions and governments. Governments are diversifying their balance sheet. Private institutions are pretty much doing the same thing, so in this way, they're aligned. Now, when we talk about the RWAs, this is when things get a little bit more interesting because this is the part where they're trying to rebuild the current system that they have. I don't know how many people here have been using the traditional brokerage systems. I don't know if anybody here has been using the interactive brokers. This is the clunkiest and the hardest to use system in the entire world, and everybody knows it, which is why the current idea is to tokenize every single thing from the traditional markets on-chain. It starts with equities, it starts with stocks, you can tokenize metals. In fact, Tether has been doing it. There's already an available tokenized gold. I believe it's on Ethereum. A couple of other private companies have tokenized gold. You can keep doing it with silver, copper, diamonds, put everything on chain. You can keep doing it with the commodities, oil, livestock. I guess the point which is the most interesting to TradFi people when it comes to tokenization is the tokenization of private equity and private credit and things like fine art, because those are the investments that are usually available only to the institutional investors. But if it can get tokenized and put on chain, then it can get democratized and the retail investors, plebs, just like us, can get an access to them as well. That's why private institutions are really bullish on this. Governments are not really, this is outside of their realm, they really don't talk about that. When it comes to other cryptos, this is when the mental model really shifts, because so far we've been talking about Bitcoin, we've been talking about, Bitcoin, they think, look at the Bitcoin, they're like, oh, fine, that's just digital gold, right? The analogy is there very easily to understand. When they think about the RWAs, analogy is also there. You think like, hey, it's already an existing asset in the real world. Let's just tokenize, put it on chain. Let's get our market share. Let's get our nice commissions and fees. Let's make money out of it. Makes sense. When it comes to other cryptos, you cannot draw a parallel between an existing asset and try to implement your existing frameworks to it. Try to think about Ethereum or Solana or Avalanche, Polygon. You can keep going about different L1s, L2s, Uniswap token. You can go into the meme coins. You cannot say like, hey, they're behaving exactly like stocks, and we can measure it, through this discounted cash flow model or through those different TradFi models. You can't really do it. TradFi people can do it. Frankly, crypto people cannot do it as well. There's no way to properly measure the fair value of crypto assets. It's a very, very new industry, which is why governments are usually skipping on those investments, but private institutions are every now and then bullish on them, and they usually use the venture capital framework. So if you're familiar with how VCs work, they usually approach early stage startups from the perspective of, hey, who's the founder? Can I bet on that founder? What's the trend there? What's the total addressable market? And then you do your the probability distribution of this working out, and then you invest in it. That's how majority of private institutions view crypto. The other side of it are the quant people, but I'm going to leave it outside of the discussion. Stablecoins. This is an interesting one. I decided to put it as a separate category because both governments and private companies are actually interested in them, but for different reasons. Private companies are interested in stablecoins for the same reason they're interested in other cryptos. They view it through the fintech perspective. If you've seen a Circle going IPO, it's another, altcoin season type of growth. It's a $1 trillion total addressable market, which is why every single institution and their mother are currently looking to launch a stablecoin just to try to capture a small market share. If they can capture a small market share of 10, 20 billion, 30 billion, that'll be fine for them and that'll justify their investments. So it's just pure capitalism. But from government perspective, this one gets a little bit more interesting because governments use it they view it as a strategic way to expand their influence on the world. And think of it from this perspective. let's think about the U.S. Everybody's familiar with the dollar. I'll call it USD fiat coin in this context. The US has approximately, 300, 400 million population. So from the perspective of the US government, there's 300 to 400 million of USD fiat coin holders. This is something that they can work with. All right, cool. Dollar also happens to be a world reserve currency, which means that majority of international trade is held in dollars, majority of investment is held in dollars, which means, like when we try to buy stocks or certain funds, we also do it in dollars. We have to hold some sort of dollars. So it means that not only their population uses dollars, but the people from outside of their country also uses dollars. That's also the holder base of their USD fiat coin. When it comes to stable coins, right, USDT, USDC, and the other ones, the opportunity here is to even further expand the market of USD fiat coin holders. And this really targets the retail, the regular people in the emerging markets. I'm talking places like Latin America, talking places like Africa, Asia, Central Asia. I'm personally from Kazakhstan. I've spent 18 years there. And we have our local currency is called tenge. And when I was a kid, you could exchange $1 for 150 tenge. Today, the course is $1 for approximately 500 tenge. It took about 15 years. So the course crashed for approximately 300%, from 150 to 500. And we're not even taking the inflation into the account of like 10, 15, 20% a year. So what it means is that holding a tenge is actually like a really bad idea. Like if you live in Kazakhstan and you hold tenge for 10 years, you probably lost a lot of your purchasing power, which is why, and Kazakhstan is not the only country. You can go to any country in Africa, any country in Latin America, any country in the Middle East, not any country, but most of the countries in the Middle East, very, very unstable currencies, very, very unstable currencies. And the governments there are usually not allowing people to sell it for dollar, or they're putting a lot of limitations to sell it for dollar, because obviously they want the population of their countries to hold their own currencies. The opportunity that Tether and Circle and the others are opening for the population in those countries is to get the access to dollars. You are switching from your unstable currency to a more stable currency, which is USD. And then you can put it on Aave, you can put it on Camino or some other lending platform and get 4%, 5% API per year. That is a great investment proposal for anyone in the emerging countries. What it means for the US is that they're expanding the holder base of the USD fiat coin, not only through their own populations, but through the populations of other countries. Which actually, like what it ends up happening is that if more people buy dollar, then the relative strength of dollar goes up in the FX market. Now, for different macroeconomic reasons, which I won't have time to explain it to you, most of the time the US government doesn't want a strong dollar. They want actually a weaker dollar, or they want a balanced dollar. So whenever there's an expanded holder base of the dollars and the strength goes up, they're incentivized to do something to decrease the value of dollar. And what they're doing is they're printing more money. So what it means is that the stable coins expanding the coverage of dollar across the world actually opens the opportunity for the US government to print even more money and finance whatever the needs that they have to achieve their strategic goals, which is why they're really bullish on it. The current Treasury Secretary, Scott Bessent, he's actively campaigning for, he was campaigning for the stablecoin regulation. It actually went into the law with the Genius Bill a couple of months ago, and he's still very bullish. He's actively working on that. So, to summarize, both institutions and governments are really bullish on this thing, but for different reasons. Institutions are trying to build companies which they can profit from, but governments are looking to use this to expand the holder base of their fiat currency so that they could have more leverage in their fiscal policies. What does it mean for all of us, right? So if you are trying to build your portfolio nowadays and you think, well, how can I get on the same hype train with the institutions and make sure I don't miss out and get the alpha from what they're buying as well? The main points are Bitcoin, gold, blue chip cryptocurrencies that are working in tandem with the treasury companies, and the technological stocks. That is all on my end. Thank you all for listening.